Today I'm going to talk about student loan debt and how it's affected in the event of a disability. Most professionals, physicians, attorneys, MBA graduates, they've all spent a lot of time and, more importantly, a ton of money to get to where they are. We commonly see clients come in with multiple six-figure loan obligations. Now, most would assume that these loans in the event of a disability would be discharged or forgiven, but that's not always the case. You see, the definition of disability is going to differ between what an individual policy will cover and what the federal loans are going to cover. So the Federal Student Aid, which is an office of the U.S. Department of Education, says that if you are totally and permanently disabled, you may qualify for permanent discharge of your federal loans. Now, how do you qualify for that? Well, it would have to be one of these three things, which is also the same definition as Social Security disability insurance. These three things are: 1, your disability is expected to result in your death. 2, you've been disabled for a continuous 60 months. Or 3, you are expected to continue to be disabled for a continuous 60 months. Now, that is saying that you are not working in any occupation. You are unable to work in any occupation. An individual disability insurance policy is going to pay if it has an own occupation definition, even if somebody's working in another occupation. So take, for example, that highly skilled surgeon who can no longer perform surgery, but he can go do pretty much anything else. Social Security is going to say, you're not disabled, you're fine. His individual policy is going to be paying him a tax-free benefit monthly. Those student loans will not be forgiven. Even in the event of a bankruptcy, because he's not making the money he was making as a surgeon, those student loans are still not forgiven. So, how do we fix this problem? Insurance carriers came up with a solution a few years ago. Guardian was actually the carrier that piloted it, and other carriers have followed suit. And what they did is they came up with a rider called the Student Loan Rider. This is a reimbursement program. And the way it works is that in the event of a disability, you pay your student loans, you submit that you paid it to the carrier, and the carrier reimburses you for the amount up to $2,500 a month, or a number underneath that which you applied for, and the rider that you have. And they're going to cover those loans. This could save people from somewhat financial devastation in the event of a disability that does not discharge these loans, which could be potentially $500,000. So if you or someone you know is a professional with excessive student loan debt, and this is a concern of theirs, we got a solution. Thanks for listening, and I hope you have a great day.